Please welcome to the stage Chairman, Heirs Holdings Limited, Mr. Tony O. Elumelu. President and Chief Executive Officer, MasterCard, Mr. Ajay Banga. Chief Executive Officer and Managing Director, Equity Bank Group, Mr. James Mwangi. Founder and Chairman, Mo Ibrahim Foundation, and Founder, Satya Capital, Dr. Mo Ibrahim. Joint Chief Executive, Standard Bank, Mr. Sim Chabalala. Co-founder and co-chief executive officer, the Carlyle Group, Mr. David Rubenstein. And our moderator, President, African Development Bank, Dr. Donald Kaberuka.
Good morning. I want to thank Secretary of State Jack Lew for the kind words and for welcoming us here. We have the easiest subject, which is finance, of course. But we have got a panel of extraordinary men here. And today we'll talk about what does it take to get more financial flows into the African continent. I met pension funds 2 days ago here, and they were saying money is not the issue. The issue is where to invest the money. And this morning, everyone says Africa is a place to be. So I want to begin with you, David. I recall meeting you in my office when you were launching the Carlyle Fund in Africa. You and I had a conversation, and you said to me, look, I'll begin with South Africa and Nigeria. The rest I will see. How has it gone for you?
Well, first I want to thank you for your support. When I was in your office, I was starting to raise our fund, and it was not easy to convince people to give money to a firm like ours to invest in Africa because we didn't have any real track record there. Whenever you're trying to raise a country fund or a continent fund like Africa, people outside of the continent will say, well, if you're so good, how come nobody in the country or the continent will give you money? So you always want to get money initially from people there, and the African Development Bank and Mr. Dangote were two of our anchor investors, and for which we're very grateful. For those who may not be that familiar with my industry, it's called private equity. It's the fastest growing industry over the last 30 years in the financial service world. It went from $3 billion under management to $3.5 trillion. That's around the world. But relatively speaking, Africa was not a major part of that private equity explosion. Even today, of all the money invested in the world, about 1% of the money invested in private equity is invested in Africa. So the appeal of Africa to us is, aside from the factors we all know, high growth rates, young demographics, governments that don't have big debts largely compared to the West, and lots of other good features in terms of the middle class growth. But there's a small figure in terms of penetration rates. We often measure the penetration rate of private equity and how much else is being done there. Typically, we like to go where there isn't a large penetration rate because that means there's not that much competition. Generally, I don't like to talk about markets we're going into because I don't want my competitors to come into those markets. I'd like to get there before they get there. But there's different in Africa. In Africa, you need to have a private equity infrastructure. You need to have other firms doing this because you have to convince the sellers of assets, the financiers of assets, the people who are in the financial service industry that this is a worthwhile undertaking. And so that's what is now undergoing as a result of our efforts, Blackstone's efforts, other firms' efforts as well. So we think that the industry will take off in Africa, and we now think that probably the growth rate in private equity in Africa will probably be greater than it will be in any other part of the world. It will take time. It's not going to be easy. It's not easy to get control of assets. It's not easy to make the changes we want. But ultimately, what we try to do is make companies more efficient. We make companies more efficient, it makes economies more productive. Economies more productive, it ultimately would be good for people living in the area. So that's our mission, is to make companies more productive, get a good return for investors like the African Development Bank, Mr. Dangote, all the others that invested with us. But in the end, it's a mission to make companies more efficient and to make economies more efficient. That's what private equity is really about.
But David, I want to follow up on that question. So for American investors in this room who may be wondering, Africa is risky, we have had things. You have been there for now almost 6-7 years.
Right.
What would you say to them?
Well, any emerging market by definition is going to be somewhat riskier than, let's say, the United States. But the theory is that if you take greater risk in business, you're likely to get greater rewards. So the reason that we and other firms are investing in emerging markets, so-called, is because the higher growth rates, the lower penetration rate of private equity, and the opportunities to get younger companies and have them grow. So yes, there are risks in Africa, there are risks in all emerging markets, there are risks in the United States as well. Often the risk in the United States can be considerable also. So I don't want to make it sound like Africa, there are no risk, and we're not worried about them. We're very cautious, but we do think the opportunities there are far greater than people thought years ago, and the great explosion in private equity, if it's going to occur anywhere around the world in the next couple of years, is probably going to be in Africa, particularly sub-Saharan Africa, where the penetration rate is about 1/12 or so what it is in the United States.
Thank you so much, David. Sim, you come from Africa's largest economy. You lead one of Africa's largest banks, which operates well beyond your own country. Yesterday, I was speaking to a large investor about your country, and he raised issues. I disagreed with him, but he raised issues nonetheless. I want you to speak to that particular investor and give him or her assurances that things are going in the right direction. But number two, I want you to share with us your experience investing outside your own country in other African countries.
Sure. I would say to the investor, first of all, let's look at the character of the country, which is the same thing as we would do to any borrower who was looking for money from us. I would say look at the Constitution. It's one of the best constitutions in the world. It's got one of the most sophisticated Bill of Rights. And so in that Constitution, there are first, second, and third generation rights which are respected in that country. I'd say secondly, look at the rule of law. It is a country which respects rule of law. I would say look at property rights. The property rights are well entrenched and they are well respected. I would say look at the democratic structures and the democratic processes. There have been orderly elections since the advent of democracy. There are strong organs of civil society. There's a strong judiciary, and indeed there's a very strong and independent central bank. So the character of this borrower is great. I would say, yes, there are issues, there are service delivery protests, there are strikes, but those are illustrative of a healthy democracy, and they're also illustrative of competition, which is also healthy for a democracy. And so this borrower of yours will have the willingness to pay you. I would say they would also have the ability to pay you, because look at their financial management. Their debt to GDP ratio is low by international standards. They collect their funds, so they will have the cash flows to repay you when their obligations fall due. And then thirdly, I would say look at their balance sheet, look at their assets. They're robust, they're strong, and therefore this is a borrower with impeccable credentials.
But as you extended beyond the Limpopo River further north, we heard this morning about economic integration, things are not working as they should. What have you learned? What can be done differently or better?
Donald, Standard Bank is 153 years old, and it's existed under the same name since October 1862. It is represented in 20 countries on the African continent and has been doing that for a number of decades. It is the largest financial institution on the African continent by market capitalization and by assets. It employs over 42,000 people throughout the continent. We have learned a lot. We've learned a lot by doing. I would say you find varying degrees of financial deepening and financial sophistication. As a general proposition, most jurisdictions have got banking as a form of intermediation, where savers save and borrowers borrow through the banking system. But increasingly, there is more pension fund reforms. As a consequence, you're seeing increasing deepening of capital markets. There are more stock exchanges that are arising. Bonds are being issued. Sovereigns are raising money. Kenya just the other day raised a very innovative Eurobond, 2 billion euro. which shows you the deepening of the financial system. I'd say from a banker's perspective, there's a great deal of competition. You've got domestic banks, you've got regional banks. My friend Tony was a fierce competitor of ours at UBA. They've got a regional strategy and they're a nuisance wherever we find them. Fiercely competitive. And lastly, I would say there is increasing discipline in regulation, there's increasing supervision and better supervision, and that is actually being reflected in the risk premiums that are attributable to the countries where we operate.
Thank you so much. Mo, now let's clarify the rules. You are not here as an activist. You are here as a businessman. So I'm going to ask you the question as a business person, a pioneer in the telecom industry. You went where others feared to go, and you made a lot of money, of course, in the process. Good for you. But tell investors here, what is your secret, if you want to reveal secrets? What has to be done to ensure that the success in the telecom industry is replicated in power, in agribusiness, in infrastructure? What would it take?
To start with, thanks. I promise to be well-mannered and behaved. I'm always, anyway. I think, of course, to start with, you really need to do your homework. It's like any investment anywhere. Africa is just a normal place. You need to do your homework before you go in. Secondly, what helped us is we designed Cell10 as a pan-African company, because we keep talking about integration of Africa, and unfortunately it's slow. It is very important to really cross the borders, and I mean we had free roaming between something Europeans still fighting to achieve. We had that 10 years ago, or 15 years ago actually. We had one structure, one team of engineers, designers, one brand, etc. That helped us a lot in trying what to do. But the issue here is we really need to accelerate regional economic integration. One thing I keep repeating, we have more mobile phones in Africa than here in the United States. We have more mobile phones than you guys. We have over 550 mobile phones in Africa, more than Europe. But we don't make one mobile phone. Imagine the lost opportunity. Why? Because we are fragmented markets. I think this is a major issue. So I think few things need to be done. If I'm allowed, I just have few suggestions to move.
Go ahead.
Yeah, I'll try to be very quick. And usually I make quick points here. We need to continue to improve governance in Africa, which is already improving. According to the data we publish every year, it's available to you free of charge if you want. One thing I think will help a lot investment if we have a pan-African stock exchange. Before any investor goes into any country, he's looking for the exit door. We have only 6 or 7 liquid exchanges in Africa. That doesn't work. We need to have a regional or regional exchanges or a pan-African. It's not difficult. It's easy and simple. And the existing exchanges could be also shareholders in that exchange. So we need to work together to do that. That will afford also cheap funding for companies and exit for investors. Simple things. I think also, I have a word also for you is business. Because it's not one-way conversation. It has to be two-way conversation. To start with, I think you need to address the gap between perception and reality. We all grew up in a diet of Tarzan movies, etc. And our perception actually is far from reality about Africa. 4 or 5 African countries dominate the news. Somalia, Libya, Sudan, etc. Problems in this country, but we are 54 countries. Please check in the other 50 countries. The second one I mentioned, the rule of law. Rule of law of Africa actually is not bad. In my business, I sued 3 governments in the local courts and I won every case. I challenge any businessman here to sue China in a Chinese court. Can you sue Chinese government in a Chinese court? Tell me if you can. The rule of law of Africa actually is better than many countries in the BRICS, and I don't mention any names. Now, you, American business people, ask for good governance, rule of law, transparency, lack of corruption, etc. Can we politely ask you for the same? Is it okay? Can you please just do clean business? You are absolutely welcome. Make as much money as you can, but can you please also pay your taxes? Because this is a major problem. Transfer pricing is causing huge problem in Africa. Fancy corporate structures is causing us huge problems. You have better lawyers, you have better financial advisors, and you can draw rings around our officials in Africa. But please don't do that in the sake of decency. Also, in the sake of your long-term perspective in Africa. If you want to succeed long-term, you have to do clean business. Otherwise, it comes and bites you on the backside. You know that. One thing I would really want to say also about the American government. The American government has been wonderful in leading the fight against corruption. I'm a great fan of the American government historically. They are the first country to fight corruption in the world and to act against corruption. That is wonderful. But I'm very surprised that when the UK is pushing now for transparency in ownership of companies and trusts, the US seems to be hesitant. Please don't wobble. Continue the fight. We don't understand why anybody needs to have an anonymous company, unless drug dealer or a thief. Why are you hesitating there? I mean, you have that backbone, and please continue to show that backbone. So please support that initiative. We also don't understand, you pioneered the Frank Dodd transparency in the oil industry, etc. Again, we don't understand why your major oil companies are using the courts to undermine that. Why your big oil companies are getting transparency? Where are their board members? Do we have people here? Guys, where is your corporate governance? You know, we are really asking these questions. So please behave. We think it's important to extend AGWA. It has been very useful. And of course, you have having a discussion here in Washington about the Exim Bank. Please have your discussion, but don't throw the baby with the bathwater. That's not smart. Thank you.
Thank you, Mo. Mo, we have limited time. I'd want you to really talk about these issues of tax and transparency, because the last G8 summit put on the table the issues of companies from the rich countries indeed not paying the taxes because of complex management models. We don't have the time, but I hope your colleagues can come to this later. Now, Mr. Mwangi, you have been extremely successful in mobile banking. That's what you're known for, but even more, bringing more people into the banking world and thereby expanding the middle classes. Can you tell us more on this?
Thank you very much. The mobile banking concept is more of a delivery channel for financial services. And essentially what we surveyed was that the fastness of the continent, the sparse population, made brick and mortar a challenge to operationalize banking. The second thing was the question of income brackets at the bottom of the pyramid. Again, affordability was a major issue, and cost of access was another issue. And we thought we could take financial services to the last mile using telecom infrastructure. And simply, we utilized the capability of the bottom of the pyramid having phones across the continent. The second aspect was the issue of a low percentage of the population being banked. And when we looked at, when we were starting, only 4% of the population was banked. And for us, that was a market failure. And we asked ourselves, how could we limit the market failure where 96% of the population is excluded by a market? And essentially what we really then focused was the barriers that existed to the low income getting a financial access. Financial access for the low income is essential to integrate them in economic transformation. If they are excluded, the economic gains of the economy don't trickle down to that segment of the population. And basically what we did was make financial services more affordable. We used the technology to reduce the cost of access and then remove most of the barriers that had to do with the regulation by lobbying for smart regulation. When you ask the population that is not connected to the national grid to give you utility bills, then it becomes a huge barrier for them. So with working with the central banks in the region that we operate, we went on smart regulation requirements, particularly on Know Your Customer. And essentially that has helped Kenya and generally the East African region to have 42% of the population now having access to banking services. So telecom reduced costs and took financial services to the last mile. But this also required a lot of innovations in products so that the products are appropriate for that segment of the population. And pricing too had to be right, and the size of the transaction had to be made to be appropriate for the transaction requirement of the population.
Thank you so much. But Mr. Mwangi, I want to follow up this. During the financial crisis, banks in the rich countries had problems. And many people thought, at least they told me, that the African banking sector was expected to follow. It didn't happen. What would you say to our colleagues in the rich world in terms of the solidity, in terms of the good regulation of African banking sector?
Thank you very much. Observing what happened in 2007, 2008, 2009, and being a player in the market, the first thing we observed was the strength of the regulatory framework on the African continent. We saw the central banks being able to manage the situation and the impact and the trading effects fairly well. But it is the banks, the individual banks, that continue to perform well. If you look at Equity Bank, over that period of the last 6 years, the market cap has gone up 4.5 times, essentially during the global financial crisis. Again, underpinning the strength of one regulation and the solidness of the individual banks. When we looked at the quality of loan portfolio, although we had the trading effects of the financial crisis hitting the continent on the third year, the spike was minimal. And within another 2 years, we had been able to override that impact. Again, showing appropriate policies in the financial sector, structure of assets and liabilities being appropriate, and the strength of the management teams that are managing African banks.
Very good. So strong regulation, good supervision, and very effective resolution mechanisms when there are problems. That's very good. Ajay, you have a lot of experience in Asia. Now you are with MasterCard, but before you were Citibank. People talk about Africa as if it was an exception. I want to tell me, from your days in Asia, are the problems in Myanmar, in Sri Lanka, in Bangladesh, in Pakistan, so different from Africa? What is it that makes people talk about Africa as if it was an exception in terms of risks?
So I actually believe that Africa is at the stage that Asia was 15 odd years ago, where a number of companies, many of whom are in this room, viewed Asia as a real opportunity to plant flags and grow aggressively. And I think Africa is at that stage, and as Jeff said in the morning, those of us who go local and who can plant ourselves properly with the right investment, the right quality of people locally, and the right technology transfer, we can win a lot. in Africa. The risk attributes of African countries are talked about a great deal, but if you go there and travel, as we've done, and you look at the opportunities there, you can find ways to control those risks in a way that is perfectly acceptable to the governance needs of most of our companies. So to give you an example, when we go with MasterCard, we go to a bank in Africa, we need to take from them, my two partners here, both with Sim and with James, we need to take from them a certain level of guarantee around our collateral or our settlement risk, which takes 2 to 3 days between the time that the merchant is paid and we collect the money back. Typically, if you went to small banks, I'd be underwriting hundreds of them. I can't do that well. We're now going to partner with institutions like the IFC, with Jin Yong helping us, to try and find a way that they could do the underwriting and provide a letter of credit or guarantee to us, which we accept as collateral. It's a way of managing the same risk. It's true of what you can do with all kinds of risk in this space. So I think that's how I view it.
Now, you and I were speaking a few minutes ago and talk about, okay, the African continent is 1 billion people, but we need to increase the size of the middle class. We need to increase purchasing power. You're quite knowledgeable on this.
Yeah, so that's my view, and it goes a little bit to what James was saying. I believe if you just look, the rich will get richer at a point of time in economic growth. There's nothing wrong with that if that capital is reinvested in the right places. But if you're going to drive consumption-led growth, which Africa will need at a point of time now, that consumption-led growth will only come by expanding the middle class and by getting people at the lower end of society to participate in that growth. That will not happen without financial inclusion. If you're left out and all you can do is operate with cash, if you can't pay a bill easily, if you can't borrow money easily, if you basically can't save money easily, you cannot be a part of what the economy is capable of doing and delivering. That's what financial inclusion is about. It's not only about doing well, it's about doing well and doing good at the same time for most companies who will benefit from that. That's what we are trying to do. I believe that cash is actually a hugely expensive medium of exchange that was created hundreds of years ago and has no reason to exist in today's modern economy. Cash costs between 0.5 and 1.5% of GDP for a country. That's to print it, secure it, and distribute it, and for my colleagues in the banks to pick it up with trucks that have 2 people in an armored truck, because if you have 1 person in the truck, cash disappears. So you need people to check it. And then all the tax evasion, you were talking about taxes, you cannot evade taxes long term without a large preponderance of cash in the economy. Third, you cannot have a great deal of illegal cross-border activity without cash. If your kids go to college in this country, drugs are on campus. Those drugs don't come in exchange for a Citibank credit card payment.
I get it.
So I think you have to just think through the role of cash and think through the transparency that comes from electronic payments, and then attach that to the idea of financial inclusion. And then you get to what James and Sim do with us as partners, which is use our technology and innovation with them to make a difference to what we can actually do to help transform transparency and reduce the role of cash, reduce corruption, and reduce leakage in the system.
Thank you so much. I'm sure Sim and Mr. Mwan cannot disagree. Now, Tony Elumelu, you and I are active in Power Africa. We're trying to get more power investments in the continent. A lot of reforms have been done, but a lot of business people want to invest in the power sector, as they did in the telecom sector. Are still concerned that there are still more reforms which are needed to provide that business confidence, to provide that clarity that they can put their risk capital there, energy investments are long-term investments, 20, 25, 30 years. What according to you remains to be done for those investment flows to come?
So last year when President Obama visited Africa, our group, the Heirs Holdings Group, committed $2.5 billion towards the Power Africa initiative. And we have been able to deploy part of that because of what I'm going to share here, which should help to drive the implementation of this across Africa. One is that in the country we decided to start from, Nigerian government had a massive reform of the power sector. And that gave us the opportunity to acquire a major power asset. And when we acquired the power asset, it generated, the day we took over November 1 last year, the output was 150 megawatts of electricity. This morning, because I get daily report of output, this morning we generated 453 megawatts of electricity. So in just about 6-7 months, we have tripled the output. This is what the private sector can do. So learning from this, African governments, and I'm happy we have quite a number of African political leaders here, we have a role to play in helping to reform the power space. If we committed $2.5 billion and we didn't have the opportunity to make the investment, we wouldn't have invested it, and we wouldn't have been able to help to triple the power output in Nigeria the way we have done in a short period of time. One of our partners, Paul Hinks of Symbion Power, is here. We co-invested together in one of these plants. The second thing is the issue of policy stability. Our political leadership and both the executive and the regulatory arms need to understand that power investment is a long-term investment. You don't want to start the process as an investor and 1 year, 2 years down the line, the policies change. So if we want to drive power, increase in access to electricity across the continent, we need to make sure that we think through carefully our policies, and once we put in place those policies, we should just have to see them through so that the rational investors can plan rationally and expect no surprises. The third thing is the issue of regionalization or harmonization of power policies across the continent. As much as if we can't do that across the continent, at least let's follow the regional economic blocks or groupings and harmonize policies so that a power investor in Nigeria can move from Nigeria to Ghana to invest, and give or take certain issues you can predict the way these policies, the regulatory environment will play out. That we need, because we need to invest in countries and across borders to help improve access to electricity in Africa. The fourth point is the regulatory issue. It takes so long to get certain regulatory approvals. We succeeded in Africa, in Nigeria, where we started from, because of the reform that was put in place. So we need to ensure that you talk to many people, foreign investors in particular, they want to invest in power. Many private equity firms have raised a lot of money, but they cannot get good deals because it takes so long to close transactions on the continent. So we need to make sure we fast-track this. And still on regulatory part, our regulators should understand that the state and stage of the power sector development in Africa is still at its infancy. So the regulatory mindset to have that we should wear in Africa, if we must grow the power space, must be different from the regulatory mindset you wear in other parts of the world where access to electricity has significantly improved. Regulators must see themselves as developmental regulators on the African continent if we must succeed in, I call it, democratizing power across Africa. And lastly, our governments need to help. We need to realize that incentives shape behavior. So if we have, like, tax, talking about tax, the right tax incentives, as we have in, like, where we do business now in Nigeria, we have 15-year tax holiday, so that encourages you to even invest more in such economy. So that will help. But let me say before closing that finance is key. Also, you know, power investment is a long-term investment. So the kind of money you need in power is long-term investment, not just short-term commercial overdraft facilities. And there are certain agencies, institutions that have a key role to play. I'm happy Kaberuka is here, he's playing a great role. The World Bank is supporting most of these initiatives also on the continent. We need to also have the American Senate and has passed the harmonize and pass the Electrify Africa bill. It will help significantly in improving access to electricity in Africa. And finally, again, our political leadership and economic managers on the continent. We need to encourage domestic savings mobilization. So we need to encourage it, one, and two, we need to make sure that when we mobilize domestic savings, we channel them into these critical areas of needs, especially power. If you go to some countries, have trillions of money already mobilized through the pension funds. But those funds are just there funding government treasury bills. It's not really helping to drive the infrastructure deficiency improvement that we need in Africa. So we need to look at it that mobilizing savings through pension funds is not an end on its own. It's a means to an end. The end is how you deploy that capital to grow what we need to fire the African economy. And I think a lot more can be said, but I know there's time constraints.
Thank you, Ton. Thank you so much. I had a follow-up question, but I saw Paul Hinks, that is in the room. My electronic timekeeper says there are 4 minutes, but Paul, I want you to come in and react to that. Do you have a sense that that predictability, that clarity in terms of the power purchase agreements is now so stable that we can see more investment flows in the power sector in Africa? Paul, I saw you here. No? Yes, you are here.
Yeah, Paul.
You can go.
Still part of the partnership.
Thank you. Thank you, Tony, for the nice words. I think right now the power purchase agreements and the agreements in general that Nigeria set out are really good.
I'm talking about all African countries.
No, I'll start with Nigeria.
Yeah,
right?
but we have limited time, so talk generally.
Yeah, because Nigeria, I think, has set out the standard, quite frankly. The problem is across all the other countries, you don't see standardization, and every time you go to make a deal, an IPP deal, you have to start out from scratch, and you spend months and months and months negotiating this different PPAs. So in some countries, every single project has its own different PPA. So it's not well organized at all. I personally think that if some of the other African countries took the work that's been invested into Nigeria, things would be a lot better and it would be a lot easier to work. But one thing, since you gave me the floor, that I would like to respond to Tony is, I think not only is it important that American companies partner with African companies, our partnership, I think, has been a fantastic example. It's worked really, really well. And as we've invested in Ughelli power plant and we're now producing 450 megawatts, I don't think it's, I think it's essential. I think you've just got to find the right partners in Africa. And there are many more people like Hayes Holdings and Tony Alumalu's and Aliko Dangote's and James Wangi's out there who are keen to do business with companies from America. So my recommendation would be that anybody who's going to Africa to do business, first of all, concentrates on finding the right local partner.
Thank you, Paul. Thank you. Now, we have 1.5 minutes, so I'm told. But I want to check from the audience if any one of you has a burning question you would like to put to these distinguished gentlemen. If there was anybody. I see none, and therefore I'll go back to my panel, asking each one of you if you have the last word. David.
Two things. First, I would say that America is probably behind other parts of the world in investing in Africa. There may be historic or other reasons why American companies have not moved to Africa with the alacrity that Chinese companies have. But I don't think it's too late to catch up. And I think the American companies need to spend more time looking at the opportunities in Africa. Private equity is only one small sliver of what we can do. Secondly, this is a very good summit, unusual summit. But as I've been to many summits and I've been to many business meetings and conferences, and everybody here has, the trick is always the follow-up. It's not the great meetings, it's the follow-up. So I hope there is a mechanism to follow up this conference, and I assume the Bloomberg Philanthropies and the U.S. Commerce Department and others will find a mechanism to make sure that this doesn't happen just once, but happens frequently, and also those of us who meet for the first time here use other mechanisms to make sure we stay in touch, because that's the best way to make sure this conference is going to be useful.
David, that's a great point. Very good. Follow-up. Sim.
2 points. There are great instruments out there, Power Africa, Trade Africa, and in particular AGOA. We hope that AGOA will be extended for 15 years, and it's our earnest hope that South Africa will be included. In addition to that, to quote President Zuma, South Africa and Africa are open for business and they're open for partnership.
That's a great point. Mo, as an activist and as a businessman.
Welcome to Africa, and I wish you make a lot of money there, and just behave yourselves. That's all.
Thank you. Mr. Mwangi.
Thank you very much. I think over the last 20 years, Africa has gone through very substantial reforms, whether it is economic, political, legal, economic reforms. And it is important that while we may appreciate what the media talks about Africa, to look and gauge where Africa is using its markets. The success, for instance, of Kenya raising $2 billion on a Eurobond speaks a lot about what is happening in Africa and East Africa specifically. What is happening in Nigeria Stock Exchange, Nairobi, South Africa again, tells the whole story because markets are never long.
Very good point, indeed. Ajay.
All the learnings I've had from doing this financial inclusion work in Nigeria and Kenya and Egypt is that you need public-private partnerships. There is an African proverb that says that if you want to go quickly, go alone. If you want to go far, go together. We really need to get that internalized. Otherwise, you won't get very far without those kinds of partnerships.
Thank you so much. Tony?
3 quick ones. One is a call on as we have come to Washington, as we go back, it will be nice that very soon we hear about the Electrify Africa bill being passed. It will help to actually improve access to electricity in Africa. 2 is what Michael Bloomberg talked about in the morning about the issue of perception and reality. I'd like to urge the American public, not just people who are here, to open their minds a bit more and see Africa beyond the prison of war and those old narratives and messaging that characterized Africa 10, 20 years ago. And lastly, as we talk about partnership with the U.S. and in fact with the rest of the world, we cannot ignore a key component of our society. Women represent over 50% of the African population, in fact 60%. And true inclusive growth cannot occur in Africa without carrying these people along. So let's also factor them in. Thank you.
Thank you so much, Tony. Now, let me take half a minute to summarize. I begin with a great point made by Mr. Mwangi. Too often here in the US or in Europe, you look at television, bad news, Boko Haram, terrorism activity here. But as he says, look at the performance of the Nairobi Stock Exchange. Look at the performance of the Lagos Stock Exchange. Right, indeed, markets never lie. Bear that in mind each time you look at bad news. Second, when David was going to Africa, he came to us, to the bank, and he says, look, you know Africa more than I do. Can we invest together? And we did. So for those of you who may still be having some asymmetry of information, you want to move into this or other African country, you still have some doubt, come to us. We know our continent. We're prepared to go there with you and meet the challenges and opportunities together. So please join me in thanking this panel and thank you all for that audience.